Right now, a single financial institution manages over $10 trillion in direct assets and routes another $20 trillion through its proprietary software. That is $30 trillion flowing through server racks just like these. The architect of this system is Larry Fink. With numbers that massive, he wields enormous gravity over the modern American economy, dictating terms to corporate boards and entire nations. Fink's path to this scale began with a total career collapse. In 1986, a single $100 million trading loss forced him into unemployment, giving him 18 months to study exactly how the market had failed him. The failure indicated that the logic governing high-stakes trading was unreliable. Fink's response was to spend the next decade re-engineering the internal mechanics of global finance. By the mid-1980s, the American economy was rapidly accelerating out of a decade-long recession.
The Reagan administration was slashing taxes and deregulating Wall Street, creating a perfect environment for financial experimentation. At the investment bank First Boston, Fink became a superstar by helping invent the mortgage-backed security. Instead of trading single loans, millions of individual mortgages were bundled together into complex, highly profitable securities that any investor could buy. The volume of money moving through these new securities was enormous, but the infrastructure managing it was entirely primitive. Trading desks in the early 80s often didn't even have computers. Traders were making massive bets based on gut instinct and basic assumptions. That lack of risk technology finally caught up to Fink in the second quarter of 1986. Interest rates shifted, his assumptions failed, and his department lost $100 million in a single quarter. Fink's sudden transition from golden boy to pariah highlighted a systemic vacuum. Even the most profitable firms on Wall Street were operating without the technology to see the risks on their own books. Unemployed at age 36, Fink spent a year and a half mapping out the structural failures of the market. He realized that the investors actually buying these complex securities, the pension funds and endowments, had no way to calculate the risks they were holding. He pitched a new type of firm to Steve Schwarzman, the founder of Blackstone. Schwarzman staked him $5 million to build a wealth management business focused strictly on risk analytics. This new venture, eventually named BlackRock, relied heavily on raw computing power. Instead of guessing how a bond would perform, they built algorithms to break apart the security, mathematically dissecting every cash flow across a timeline. Fink's rule: they wouldn't invest client money until the underlying statistical risk could be mapped and calculated. By prioritizing statistics over intuition, BlackRock was engineered to be a risk calculator first and a trading firm second. By 1994, that analytical edge was put to the test. General Electric, led by Jack Welch, had acquired an investment bank saddled with roughly $10 billion in highly complex, toxic mortgage derivatives. The broader financial industry was paralyzed. Traditional Wall Street firms refused to touch the portfolio because they lacked the computational tools required to look inside the securities and measure the danger. GE hired BlackRock. Fink deployed his team of quantitative analysts to act as financial ghostbusters, mathematically evaluating the troubled assets, restructuring them into safer derivatives, and slowly offloading them to the market. Earning tens of millions in fees for the cleanup, BlackRock proved they had a monopoly on understanding complex assets. While the rest of Wall Street traded on instinct, Fink's team traded on superior financial engineering. Fast forward to 2008, and the exact same mortgage-backed securities Fink helped invent back in the 80s were melting down the global economy. As major banks collapsed under the weight of toxic loans, BlackRock stood isolated from the damage. They possessed the only analytical infrastructure capable of calculating exactly how deep the crisis went. The U.S. Treasury and major commercial banks put Fink on speed dial. Government officials like Hank Paulson called BlackRock to evaluate the toxic assets and help engineer the rescue of failing institutions like Bear Stearns and AIG. The man who helped build the financial weapons that broke the market was the only person with the tools required to defuse them. This diagram shows how BlackRock pivoted in the ashes of the 2008 crisis. They moved entirely away from the active, risky trading represented by the jagged line and went all in on exchange-traded funds, or ETFs, shown by the wide, steady growth area. Instead of guessing which individual stock might win, ETFs rely on automated algorithms to own a tiny piece of every company in an index. They abandoned gut instinct stock picking capturing massive volume and charging minimal fees, absorbing thousands of stocks into a single pipeline. By pulling millions of retail investors into these funds, this automated system quietly made BlackRock a major shareholder in virtually every public company in America. The 1986 crash marked the end of the cowboy era on Wall Street. In its place, Fink built an automated, computer-driven infrastructure that now manages the flow of trillions of dollars in global capital.